welcome back to Paul Online, Paul on YouTube. On this video, we're gonna talk about balance sheet. We're not gonna do yet the balance analysis. We're gonna keep it for another video. We're gonna do some exercise in other videos too. This one is more of a introductory video to the balance sheet, which is information that you must know that will guide you through the analysis and through the exercises. So, first of all, you may ask yourself, why are we studying balance sheet, or why balance sheet? Why do we need the balance sheet? Well, balance sheet can answer to questions like how much cash was at our hand at the end of a period? What was the total debt of a company? What was the mix of internal and external financing at the end of the period? How much was owed to the company by the guests? What was the operations ability to pay their current debt, or what was the financial strength of the operation? So there are four main purposes, four main reasons to study the balance sheet. The first of all is because it reflects the financial position of a company at a certain time. This certain time is very important for you because it differs from other financial statements like the statement of cash flow and the income statement. The balance sheet is unique, is one day, is that moment when they did it, it was like this. But it might be that in 5 minutes later it was completely different. However, the statement of cash flows and the income statement, the other financial statements, they portray the information over a period differently than the balance sheet. The second point is that it reflects the big equation, assets equals to liabilities plus owner's equity. This is 100% here, then there should be 100% here. The third point of the balance sheet is that it gives information for decision makers. For example, if I show my balance sheet to a bank, I can prove that I really deserve having that much money. If maybe my balance sheet proves that I'm very bad at paying my debt, maybe the bank will not be able to give me that money. He will not want to give me that money. Because he says, look at this balance sheet of this company. They are not really paying what they're owing for other people. So why would we borrow money to someone that apparently doesn't know how to pay their debt? And the last point is that the balance sheet can reveal for you the liquidity of an operation. Liquidity is important in financial industry because if you have a liquid company, it means that if something bad happens, you can easily give cash. Cash is the liquid in financial statements. Or current assets are very liquid assets because you can transform them in cash very easily. And accounts payable as well, they're current liabilities because you can transform them into cash very easily. It's very important for a company to manage their liquidity. There's no a lot of liquidity is good or non-liquidity is good. There are not two extremes. The company needs to know how to manage in the middle. So the last point that I wanted to talk to you is what are the limitations of the balance sheet? We know that anything can be perfect. Nothing can be perfect, and neither the balance sheet can. One of the problems of the balance sheet is that sometimes you cannot really reflect, you cannot really show the real value of the assets. For example, in the balance sheet we have like equipment, assets. It's not easy to know how to depreciate them. It's not easy to know the real value behind them because of the cost principle that we talk about. So over the years, this value might change, but the balance sheet cannot really record it. That's why many investors, many creditors, many managers, they don't look as much at the balance sheet as they do for the income statement. The second limitation of the balance sheet is that it fails to really show what is the value of people. Especially in the hospitality industry, where we have many staff, many co-workers. What is the value of these co-workers? Because you train them, you give them development, they become better than the competition. We have our differentiation. They are different, they are our people. But it doesn't change the value in the balance sheet. The third negative point of the balance sheet is that, as we said, it's in a specific point of time. It doesn't take an over a period, it's a specific point. So it's very easy, that it's very fast that changes might occur in the balance sheet. So you have to keep doing it. The final and fourth point of the limitations of the balance sheet are that the balance sheet has a lot of things that are estimated. For example, you estimate what is a percentage of your accounts receivable that you will not receive actually. So because of these estimations, because of this believing that you're not going to receive 3% of your accounts receivable, because we know that in business in general, some people don't pay, some people cannot pay, some people are not willing to pay you back. So you estimate, for example, that 5% of your accounts receivable will not come, and finally you see that 10 or 15% didn't come, and the balance sheet didn't show it at that specific time. Now that's the final limitation of the balance sheet. Thank you guys for watching again. Please take a look at the Facebook page. Text us about anything you want. Text us about what courses you want to hear about. And I'm going to tell you that next video we're going to talk about the content in the balance sheet. We're going to go through current assets, current liabilities, owner's equity, etc. See you next time.